Hi, I welcome you to Caroline's Online Academy. This is the second class in the series Basics of Accounting. In the first class, we discussed about definition of accounting and what an accountant does and what we mean by actually accounting or preparing books of accounts. In this class, I'm going to explain a few terms that were used and also discuss about the objectives of accounting, the reason why we are accounting. Okay. When you look at the definition, you see, we use a term called stakeholders. And while I was explaining the definition, I used a story to explain the definition to you, in which Dada, a cricketer, the owner of the tea shop, comes and questions the employees about what's happening in the tea shop, for which the employees prepare books of accounts, right? So in that case, I showed only the owner of the business as someone who would be questioning. But in real world, a lot of people who are affected by are affected by how a business is performing. So every one of those people who are affected by how the business is performing actually would like to know how the business is performing at, if it is doing good or bad. So anyone who has some interest in the business, because the performance of the business would either help them in some way or be detrimental for them, they are known to hold stakes in the business. Stake, S-T-A-K-E, stakes in the business. And the persons who hold stakes in the business are called stakeholders. Now, from a layman's point of view, you might wonder who the stakeholders are, okay? And you might think that only the owner has stakes in the business. But as a matter of fact, it is not just the owners. A lot of people actually hold stake in the business, and we're going to look at them one by one. First is the owner. The owner obviously is interested in how the business is performing because he has invested his money in it, right? So that is self-explanatory. Next is the management. Management sometimes is the owner, the same as the owner, or sometimes it is different. For instance, in a small organization, the owner might be the one who is managing the business. But in a large organization, usually the owner hires people for him to manage things that he is not able to do by himself. Understood? So those managers are taking critical decisions in the business, and in order to take those decisions, those people need to know how the business is performing, right? And for which they would use the accounting information to take those decisions, and therefore management also are stakeholders. And the third set of people who are stakeholders are employees. Employees means the people who are working in the organization. Obviously, the people who are working in the organization would like to know how the business is going, because they need to understand if they can continue working in this place or not, or if there is any scope for growth in this organization or not. For instance, in case there is an organization where there is no scope for growth, and the organization is limited, and there is already a manager who is doing this job perfectly, and then the person who's next to him, as he might understand from the accounts of the business that there is going to be no growth, he will probably want to move to a different organization to raise himself to a level of manager and not wait in this organization, right? Similarly, laborers who are working in an organization might look into the accounts of the business to understand the amount of profit earned by the business, to understand if they are being given enough wages proportionate to the amount of profits that is being earned, and if they are given bonus according to the bonus act or not. So all of that the laborers or the employees will understand only by looking into the accounts of the business. You might have heard of the case of Nokia in India. Nokia in India closed its shutters one day and didn't open the other day, the next morning. So what happens is, in that case, the employees suddenly were out of job. Had those employees been following the accounts of the business and understood the fact that the company has been incurring losses for a long time, they could have probably made some arrangements for them and probably left that job, right? So employees also would like to know how the business is performing, and therefore they also are likely to look at the accounts of the business. Understood? The other people, apart from owner, management and employees, creditors and financial institutions that lend money to the business would like to understand how the business is performing. Creditors are people who provide goods or services on credit basis. Financial institutions include bank, non-banking financial companies, or any other lender for that matter. Now when they lend money, they would like to understand if the business is capable of repaying it or not, right? So now the only way the creditors and financial institution can find out if the business is capable of repaying or not is by looking into the accounts of the business, and therefore they would also be interested in finding out or asking questions about how the business is performing. The other people are investors. Investors in this case are different from the owners. People who invest in the business for a short period of time, or people who buy a small percentage of the business's shares in order to multiply their wealth and all that. Now these people, before investing, would like to look at the accounts of the business to understand how the business is performing, so they'll know if they can actually invest in this company or not, or the organization to grow their wealth or not. In case the organization is not doing well, they'll probably not invest. Understood? And then customers would also look into the accounts of the business, because customers would like to know if they would be able to continuously, if they will get able to get continuous supplies from the company in which they are purchasing from. Understood? In case the company is performing badly, they will have to find alternate suppliers for the products that they would require, right? So obviously, if the company from which they are actually purchasing now is doing bad, then they will look for alternatives, or if they are doing good, they will be okay with this company itself if the quality and other things are all right. And therefore customers would continuously monitor the performance of the organization from where they are purchasing goods, right? So in order to make sure that they have regular supply of goods. For instance, let's say there is a car manufacturing company and it has a lot of subsidiary companies nearby, or for that matter, let's keep it as you do not know what a subsidiary company is. Let's say there are some small organizations nearby, and the car manufacturing company purchases left hand side body of the car from one company and right hand side body of the car from another, and it purchases brake and steering and seats and everything from another company. All these small companies. Okay, the car manufacturing company only manufactures the engine and then assembles all the products purchased from all of these small organizations and then releases the car. Assembles and releases the car. Okay, now suddenly, if a company that is supplying the brakes to this car manufacturing company runs into losses and closes down, then what would happen to the performance of this car manufacturing company? This car manufacturing company will also be forced to stop its production until it finds another supplier for brakes, correct? Because without brakes, this company cannot release its product. So as a customer, this company would like to know the performance or the financial position and status of the organizations that are supplying products for this company, correct? And thus customers would also be are also stakeholders who hold stake in a business organization. Tax authorities and regulatory bodies means all those organizations that that create rules and monitor how an organization should perform or function in a country. Understood? For instance, in India we have SEBI, ICAI, or RBI, and all of those, or FEMA, FERA, all of those organizations there whose main motive is to regulate certain aspects of business. For instance, SEBI regulates how if shares are issued, all securities related transaction, that is issue of shares or purchase of shares or selling of shares, transfer of shares, and all those things. And it protects all the investors in an organization. Similarly, we have employee provident fund organization, which protects the interests of all the employees of an organization. That is one regulatory body that any organization has to answer to. So all of these regulatory bodies and the income tax authorities who would actually tax the organization on the basis of the income earned by the organization would like to look into the accounts, because the information that they need is actually there in the books of accounts. As books of accounts accounting is the language of business, these organizations look into the books of accounts to understand how well or how bad the organization is doing, or what is actually happening in the business, in order to regulate those businesses according to the laws. Understood? Similarly, government would also like to know how a certain business is performing, how a particular organization is performing, in order to understand if a certain industry or sector needs any assistance or not, or if a particular organization can be taxed more than what it is actually taxed, because they're already earning a lot of money, or making a lot of profits. Or to make such big huge policy decisions, government would also like to know how every organization is performing. And also government would also want to know how an organization performs, in order to make sure that if they are actually following all the laws and regulations properly or not. Okay. And the next stakeholders are set of stakeholders are researchers. Researchers are people who study the market, or study a certain thing to understand how certain area is evolving and all that. So people researching into the performance of the business and all would like to look into the accounts of the business to understand how an industry is evolving, and if the industry requires a boost, or what has actually helped the industry win, on all of those things that they are researching into. In order to understand all of that, they look into the books of accounts of the organization to come to conclusions in their research. Okay. And the general public also would like to know how the organization is performing, because an organization does not exist in isolation. It exists as a part of the society, and it is taking a lot of wealth from the society, like space, water, air, and all that. And so the general public would like to know if the organization is working in a just manner, and if it's exploiting the resources or not. And are they giving back to the society as much as they are taking? For instance, in Tirunelveli, Tamil Nadu, there was a huge uproar against PepsiCo taking 6 lakh liters of water every day from one of the perennial rivers of the town that we talked about, of Tirunelveli. Understood? So people are questioning the huge amounts of profit the company was earning using the resource, their water resource. Understood? And they questioned, they wanted that to stop. Now people came to know about the huge amount of profits that PepsiCo was earning only because they looked into the books of accounts of PepsiCo and understood the fact that the company is earning so much of profits using the water that is purchased from their society, or from their natural resource. Understood? The general public would also like to know how the business is performing, and they also hold some interest in the business, and therefore they are also a set of stakeholders. So all of these people and few more are stakeholders. So this is only to explain who stakeholders are. Stakeholders are basically anyone who is affected by the business and therefore has some interest in the business. That person is called stakeholder. Understood? So any person, any stakeholder would want to look into the books of accounts, because as he is affected by the business, in order to take rational decisions, logical decisions, they would want to look into the books of accounts and make their decisions. And it is for these stakeholders that accountants prepare the books of accounts by recording, classifying, summarizing, and accountants actually are answerable to the stakeholders, and therefore they communicate the accounting information to these stakeholders. Understood? Okay. Now that's about stakeholders. The next topic that we're going to learn today in this video is objectives of accounting. Objectives of accounting means the reasons or the aim for actually doing the accounting. We have already discussed it in the previous class, and while I was explaining stakeholders as to why we are actually accounting. But to put it in points, the first reason why we are accounting is, or the first aim that we are trying to achieve by accounting, is to systematically record transactions. In case we don't record the transactions, numerous transactions that take place in an organization, we are bound to forget it. Human brain forgets things, right? So in order to avoid forgetting it, in order to systematically record the transactions, we perform accounting. We do accounting. The second reason is we would, as a owner of the business or as any stakeholder, we would want to know how a business is performing, if it's making losses or profits. Is it worthwhile to continue the business or not? We would like to know answers to all of these questions, right? So in order to ascertain the financial results of the business, a financial result means the profit, is it making profit or loss? Profit is a financial result, loss is a financial result. So ascertain the financial result of the business, you need to prepare the books of accounts. Understood? And the third reason why we need to prepare books of accounts is to ascertain the financial position of an organization. Financial position refers to the assets and liabilities held by that organization. Only when someone has an idea of the total of assets and liabilities held by an organization will that person be able to understand the ability of the business to grow or ability of the business to function smoothly. Understood? So financial position of a business is important from the point of view of stakeholders. So in order to understand the financial position of the business, we would that financial position can be found out only if we account for transactions, and in order to do that, in order to finding that is one of the objectives of accounting. Okay, and I'll come to the fifth point. We'll get back to the fourth point after the fifth point. The fifth point is what I have been discussing about all this while. The main reason why we are actually accounting is to make sure that we have enough information to provide to the stakeholders who are affected by the business, for them to help them to make rational decisions with respect to the functioning of the business. Understood? Okay. Now the fourth reason or the fourth objective or one of the objectives of accounting is to ascertain the liquidity and solvency position of a business. Liquidity means the measure of let's say liquid assets in the business which you can use on a day-to-day basis to for the functioning of the business. For instance, an asset might have a huge machinery and some raw material and some cash. If an asset has a huge machinery which can produce finished goods, and if that machinery needs raw materials, the raw materials can be purchased only using liquid assets like cash or bank or stock itself is a liquid asset. Okay, so the amount of liquid asset that is there in a business is very important, because without the liquid assets, an organization cannot perform its day-to-day functions. Understood? So, if in order to find out if an organization has enough liquid assets or not, one has to perform the accounting function and prepare the books of accounts, and using that we will understand the liquidity position of the company, organization. Similarly, we also need to understand the solvency position of an organization. Now, what we mean by solvency is, I'll explain what being solvent is in order to understand what solvency means. Okay, being solvent is if a particular person's assets are are enough to settle all his liabilities. In case he has to settle all the liabilities, if he has enough assets to actually settle all the liabilities, then that person is said to be solvent. In case his assets are not enough, that is, even if he sold all of his assets, if he will not be able to settle his liabilities, then that person is known as insolvent. Now, in a business, every now and then the investor of the business would like to understand if the business is solvent or not, because it might happen that the business has been incurring a lot of losses, and therefore the business has actually lost a lot of assets, and they might actually be in a insolvent position. Now, continuing the business after becoming insolvent is not a very good idea, or it is not possible at all, and therefore the owner of the business time and again is supposed to check if the business is solvent or insolvent, or if the business is going towards insolvency or not, if the business is continuously incurring losses or not. Now the organization can find out only by accounting for transactions and preparing financial results and financial position of the organization. Understood? So with that, we have come to the end of this video, and in this video I talked to you about stakeholders, explained who stakeholders are and the objectives of accounting. In the next video, we'll be looking at some basic definitions that we'll be using in the process of learning accountancy, and which every accountants use on a day-to-day basis. Okay, so see you then in the next video. Till then, bye.